Ever pondered over how index fund investing operates? Well, let's dive right in. Index fund investing is a type of mutual fund that's designed to match or track the components of a financial market index. Imagine it like a mirror, reflecting the market's performance. But why opt for an index fund? Two words: low cost. They have lower operating expenses and low portfolio turnover, meaning you're not constantly paying to buy and sell securities. This can save you a significant amount over time compared to other types of funds. Now you might be thinking, but don't I need an active manager to beat the market? Interesting point, but the data tells a different story. Index fund investing is a passive form of fund management that has been successful in outperforming most actively managed mutual funds. So, next time you're considering your investment options, remember the power of the index fund. Index fund investing may sound complicated, but the process is quite straightforward. Let's break it down together. Firstly, we have to decide on an index. An index is essentially a basket of different stocks or bonds, representing a broad segment of the market. They come in all shapes and sizes, covering everything from the total U.S. stock market to international bonds to specific sectors like technology or healthcare. So it's essential to choose an index that aligns with your investment goals and risk tolerance. Once you've decided on an index, the next step is to buy shares. This is where index funds come in. An index fund is a type of mutual fund or exchange-traded fund that aims to mimic the performance of a specific index. You can purchase shares of an index fund from various places such as brokerage firms, mutual fund companies, or even directly from the fund company. Now you might be wondering, what happens with my money once I buy shares? Well, your money is pooled together with other investors' money and used to buy the securities in the index. As the price of these securities rises or falls, so too does the value of your shares in the index fund. One crucial aspect of index fund investing is diversification. By investing in an index fund, you're not putting all your eggs in one basket. Instead, you're spreading your investments across a wide range of companies or sectors. This can help to mitigate risk and smooth out the ups and downs of the market. Remember, while index fund investing can offer a simple and cost-effective way to access the potential returns of the market, it's not without risk. It's essential to understand that the value of your investment can go down as well as up. So, as you can see, index fund investing is a simple and effective way to invest in a broad market index. It's not about trying to beat the market, instead it's about trying to match it. And in the long run, this approach has proven to be a winning strategy for many investors. Now, let's summarize the key points about index fund investing. Index funds, as we've discussed, are a type of mutual fund or exchange-traded fund with a portfolio designed to match or track the components of a market index. They provide a broad market exposure, low operating expenses, and low portfolio turnover. One of the most attractive aspects of index fund investing is the low cost. Because these funds simply mirror a specific index, there's no need for a fund manager to research and select individual investments. This lack of active management typically translates into lower fees for investors, which over time can make a significant difference in your returns. Another advantage is the broad diversification. By investing in an index fund, you're effectively buying a small piece of all the companies in the index. This means you're not putting all your eggs in one basket, reducing the risk of your investment. Then there's the potential for better long-term returns. While it's true that index funds won't typically outperform the market, they also won't underperform it. And over the long term, the average investor is likely to earn a higher return by investing in an index fund than by trying to pick individual stocks. However, it's also important to remember that index fund investing does have its downsides. One of the main ones is the lack of flexibility. With an index fund, you're committed to the performance of the index. If a particular sector or company within the index is performing poorly, there's no option to remove it from the fund. Additionally, while index funds generally yield solid returns over the long term, they may not always outperform the market. Some active funds and individual stocks do achieve higher returns. However, predicting which ones will outperform is a challenge even for professional investors. Remember, index fund investing is not about beating the market. It's about making the market work for you.